Once again, good afternoon to all of you. This is our next video. So in this video, we are going to see what are the types of instruments that is available in the money market. See, in the last videos, we already covered up what is capital market, what is primary market, what is secondary market. Okay, now we should also know what are the main instruments that are drawn in the money market. Okay, so I think all of you know what is money market, right? So let us discuss the different types of instruments that are being traded in the money market. Okay, let's do one by one. So my name is Priyanka Mahanta, Assistant Professor of Business Administration Department, USTM. So let's begin the video for today. So instruments of money market. So first one is the call money, or we can call it as the short notice money. Okay, so let's understand what it is. So it is the money borrowed or lent on demand for a short period of time, generally one day, is known as call money. The term of the call money does not include Sunday and other holiday. Okay, so it is used mostly by banks. It means that when one bank faces a temporary shortage of cash, then the bank with surplus lends cash to the former bank with money for 1 or 2 days. So it is known as interbank call money market. Okay. Besides bank, other organizations like mutual fund companies, insurance companies, etc. also deals with call money. So the market of call money is done over the telephone. The liquidity of call money is just next to cash. So if we say the second name of call money is short notice money. Sometimes it may happen that some bank, let's take for example one particular bank, suppose SBI, okay, and they are facing temporary shortage of money now, currently, for today itself. Okay, we are talking about today. So what they can do is they can borrow money from another bank who has surplus money, like suppose from UCO Bank. Okay, for 1 or 2 days, they will borrow the money, they will do their operations, and after 1 or 2 days, they are going to return the money back to that bank. Okay, so ultimately we can say that it is a kind of emergency money. Okay, whenever we need, we can just get the money in short notice of time. Okay, so it is taken for a day, or we can say for an overnight, but not exceeding 7 days in any circumstances. Okay, so whenever we are borrowing such kind of money in short notice, then we cannot exceed more than 7 days. 7 days is the maximum number of days, but mostly they try to settle it within 1 or 2 days. Okay, then another thing is that this short call notice money, refers to money given for up to 14 days. So if the loan is given for 1 day, it is called money at call. Okay. So if loan cannot be called back on demand and will require notice of at least 3 days. Fine. Next one is treasury bill. So let's see what is treasury bill. So on behalf of the government of India, treasury bills are issued by the Reserve Bank of India, that is RBI. So with the help of treasury bill, the government of India can get short-term borrowings as they sold to the general public and banks. So the treasury bills are freely transferable and negotiable instruments and are issued at discount. As treasury bills are issued by the RBI, they are considered the safest investment. Okay, and the maturity period of treasury bill varies from 14 days to 364 or 65 days. Okay, so here what happens, we can say that treasury bill is one of the safest option to invest. Why? Because it is being issued by the RBI itself. Okay, on behalf of the government of India. Okay, so what they can do is if sometimes the government is in need of money, they can ask RBI to issue such kind of treasury bills in the market. Okay, so when the general public or banks, maybe whoever is interested, they will purchase it, so they will get the money immediately over there. Now we have seen that in the last line it's written that treasury bills are issued at, we can say, at discount. Okay, that means if the actual cost is 100 rupees but they are issuing at 80 rupees, okay, but at maturity, suppose they are giving this treasury bill for, suppose it lasts from 14 to 365 days, not more than 1 year. Suppose they are giving it for only 6 months, so at the end of 6 months these treasury bills will be redeemed. Okay, and it will be redeemed at par value. Par value means at the exact value or at the actual value. If the actual value was rupees 100, then you are going to get rupees 100 itself, but you have invested how much? You have invested rupees 80, right, to purchase the bill. So we can say that overall this treasury bill is one of the safest investment, because it is issued by RBI on behalf of Government of India. And then we can say that treasury bill is transferable as well, and it is issued at a discount, okay, less than the actual price. And whenever it gets mature, it is redeemed at par value. Par value means at the actual price of the bill. Okay. Next one, commercial bill. So what is a commercial bill? See, commercial bill, also known as trade bill or accommodation bill, are the bills drawn by one organization on another. So commercial bill are the common instruments of money market. So it is the most common instrument that is being traded in the money market, which are used in credit sale and purchase. So the maturity period of commercial bill is for short term, generally for 90 days, that is for around 3 months. So however, one can get the commercial bill discounted with the bank before the maturity period. Okay, so the trade bills are negotiable and easily transferable instrument. The drawee of the commercial bill honors the bill on due date. Okay, so here this means that it is this kind of bill are common in the money market. Okay, which are used for credit sale and purchase. Okay, so for example, these bills are drawn when goods are sold on credit. Okay, when goods are sold on credit, and when the buyer accepts the bill and return to seller. Okay, the seller may either retain the bill or he can get it discounted at bank itself to get the money over there. Okay, so I hope it's clear. Let's repeat it once again. Commercial bills are drawn. Okay, commercial bills are drawn when goods are sold on credit. That means there is no cash transactions here. You are taking the goods on credit. So when the buyer is taking the goods on credit, the buyer needs to accept the bill and return to seller. Okay, then the seller can keep the bill, or whenever required he can go to the bank and get the bill discounted. When he will discount the bill, he is going to receive the money from bank. Next one is commercial paper. So what is commercial paper? An unsecured promissory note issued by public or private sector companies with a fixed maturity period varying from 15 days to 1 year is known as commercial paper. Now this is something unsecured. Okay, it is unsecured, but they are promising you that they are going to return you the money, and they have a fixed kind of maturity period, maybe ranging from 15 days to less than 1 year. Okay, so it was for the first time introduced in 1990. As this instrument is unsecured, It can be issued by companies with creditworthiness and good reputations. Yes, because if we say that all the companies can issue commercial papers, then what will happen? The company who are not even financially sound, they will issue such things, and once the buyer purchases it, later on they will not be able to return the money, then it will be a kind of fraud, right? These things can be only given by those companies which have good creditworthiness, and they have a good reputation in the market, and they have a good stable financial condition. So the main investor of commercial papers are commercial bank and mutual fund. Okay. So here the main investor of commercial papers are commercial bank and mutual fund. The funds raised through commercial paper are used by the companies for meeting their flotation cost. Okay. Moving on to the next thing. Next one is features of money market instrument. So what are the features of money market instruments? Let's see. First one is high liquidity. So one of the key feature of this financial asset is high liquidity offered by them. Okay. They generate fixed income for the investor, and short-term maturity make them highly liquid. Owing to these characteristics, money market instruments are considered as close substitute to money. See, when you are purchasing any instrument of money market, the maturity period of any instrument in the money market is less than 1 year. Even if you are purchasing treasury bill or commercial paper or commercial bill, anything it can be, but its maturity is always less than 1 year. So within that 1 year, you can get your money back, right? It can be 15 days also sometimes. For example, the treasury bill may be issued for 15 days. So within 15 days, you are going to earn money, and also you can get some kind of return over it, some kind of profit over it. Okay, so this money market instruments are considered close to money itself, because whenever you, it's only about 1 year, right? Next one is it's a secure investment. So these financial instruments are one of the most secure investment avenues available in the market, since issuer of money market instrument have a high credit rating and the return are fixed beforehand. The risk of losing your invested capital is miniculous. That means it is secure. Okay, it doesn't have much risk over here like the equity shareholder or like the other kind of securities in the market. Okay, because here though the companies or the issuers who is issuing such kind of instruments, they are of high credit, they have a good reputation, they have a good rating. Okay, and the returns are fixed beforehand. Like for example, if we talk about treasury bill, so they are issuing the treasury bill at discount, right? The less than the actual price of that particular bill. So on maturity, what they are doing, they are providing you the money at par. That means they are providing you the actual value. So this is decided beforehand itself, right? That they are going to issue at a discount, but they are going to give you at par when its maturity is done. Fine. The last one is fixed return. So since money market instruments are offered at a discount to the face value, the amount that the investor gets on maturity is decided in advance. This effectively helps individuals in choosing the instruments which would suit their need and investment. Okay, so all the things, like it can be commercial paper or treasury bill or commercial bill, everything we can say return is fixed beforehand. Okay, so the investor, according to his need, can decide which instrument is beneficial to him. Fine. Okay, so now we are going to see the difference between capital market and money market. So the first basis of difference is the participants. So who are the participants of capital market and primary market? So Individual investors as well as institutional investors like financial institution, banks, corporate house, and foreign investors participate in the capital market transactions. Okay, we can be the individual, it can be bank, it can be some financial institution. So all has the right to invest and to trade in the capital market. Okay. Now let's see in the money market. So in money market, the participants are RBI, commercial banks, financial institution, mutual fund, and corporate houses. Individual investors do not participate in the money market. Okay. Next basis of differentiation is instruments traded. So what are the instruments that are being traded in capital market and money market? So in capital market, the instruments are equity share, preference share, bonds, debentures, etc. So we have already studied the meaning, what is equity share, what is preference share, or what is debentures. Okay. And in the money market, some of the main instruments that are used are commercial bills, commercial paper, treasury bills. Okay, these things also we have already discussed the meaning about it, and these instruments are basically of less than 1 year. Okay, but when we are talking about capital market, it's more than 1 year. So now next one is the duration of securities traded. So this is about the time period or the time frame. Now, as I already said that capital market deals in medium and long-term securities, which are for more than 1 year. Okay, so all the medium and long-term securities are traded in the capital market whose maturity period is more than 1 year. And in money market, it deals in short-term securities having maximum tenure of 1 year. Like we have already seen that it may be treasury bill or commercial paper. The maturity period goes from 15 days to 365 days. So within 1 year, it gets matured. Okay. Next one is expected return. Here in capital market, high returns on investment. That means the risk is more, right? The risk is more, that's why the return is also more. Okay, so higher returns are expected from such kind of instrument in the capital market. Like for example, if you have bought a share of Reliance 3-4 years back at 200 rupees each share, but now as you know that the demand of that particular share has increased in the market, and due to which the price of the share has reached around 1500. Now you have purchased at 200, but now currently the price of the share is 1500. That means you are gaining 1300 extra. The return is more, right? Next one, money market. So in money market, there is always a trade-off between risk and return. So low risk involved leads to less return, because you know that mostly the RBI and reputed companies are involved in the instruments that are issued, okay, in the money market. So that means we are in a safer side. The risk is low. So when the risk is low and you know that you are in a safe side, your return will be less over there. Okay. Next one, safety. So capital market is more risky. Already discussed, it's more riskier. You don't know what's going to be happening in the future. Even the market may go down, the market may go crash. You don't have an idea about the future, right, over there. But in a money market, you know that you are safe. You are going to get your money over there because it's of short duration. Okay. Now moving on to the next one, we are going to see the formation of SEBI, the role of SEBI, and how the SEBI works. Okay, what is SEBI now? SEBI, we can say in general, is an ruling body that governs the stock exchange market. There should be some body, right? Otherwise, the market or the companies, the brokers, they can just they can just make fraud over there. Okay, they can do some kind of unwanted activities which may lead to some kind of unwanted situations to the customer. So let's see, when was SEBI formed? So the Securities and Exchange Board of India was established as a non-statutory body in 1988 for the regulation of securities market. So it was established at 1988. Okay. It acquired the statutory powers on 30 January 1992 in accordance with the SEBI Act 1992. So it has got its power on 30 January 1992. So SEBI became an autonomous body on 12 April 1992 and was soon constituted as the regulator of capital market under the Government of India. The headquarters of Security and Exchange Board of India is located in Mumbai, Maharashtra, and has 4 regional offices in New Delhi, Kolkata, Chennai, and Ahmedabad. So during the financial year 2013 to 2014, SEBI opened several local offices in the cities, namely Jaipur, Bangalore, Guwahati, Bhubaneswar, Patna, Kochi, Chandigarh. Okay. Now let's see what are the role of this SEBI. Okay. Here it's written that SEBI is a regulatory authority established under SEBI Act 1992. So this act and this date should be remembered by you all. Okay, this is important. It may come in some competitive exam as well in your MCQ part also. You should remember when was SEBI actually established. Okay. In order to protect the interest of investors in the security as well as promote the development of capital market. It involved regulating the business in the stock exchange, supervising the working of the stockbrokers, share transfer agent, underwriters, merchant bankers, as well as prohibiting unfair trade practices in the securities market. So the main objective why SEBI was established was that to protect the interests of the investors. That means I don't know what's going inside the market, right? I don't know what's happening over there. I want to invest, but I have invested my money, but I have never got my money back over there. I lost all the money in the market. Why? Due to some unwanted insider trading maybe. Okay, there was some kind of unfair practices maybe. So such kind of situation has occurred in the past, okay, due to which there was a need of such kind of statutory body to regulate the capital market. Okay. So the first one is that to promote and regulate the self-regulatory organization. Okay. To promote and regulate means so that if there is one kind of authority or one kind of regulatory body is there, then they are going to promote, they are going to regulate. That means they are the one who is going to set up the guidelines how the capital market should work. So when there is certain kind of guidelines, definitely all the companies will have to follow the guidelines. Not only the companies, the intermediaries like the bank or the broker or the underwriter, okay, everyone needs to follow the particular guidelines which are being provided by the regulatory body over there. Okay, to prohibit insider trading in securities market. So such problem was there in past, but nowadays there is no such problem. Why? Because of SEBI's initiative over there to regulate the business of stock market and other securities market, to prohibit fraudulent and unfair trade practices, to regulate huge acquisition of share and take over the companies, to promote the awareness among investors and training of intermediaries about safety of market. So overall we can say that SEBI is one kind of institution which sees the overall working of the capital market, how it's working, whether there is any kind of problem or any kind of fraudulent activity going on. If it's going on, then how they can stop it, okay, how they can take actions over it. And also they need to create awareness among the investors, okay, and also train them because most of them don't know how to invest. And but now SEBI has several such kind of programs where they are now what to say. SEBI also has, but even the exchange board like NSE and BSE, they also have certain kind of programs for the graduate students also to create awareness of investment. No, so these are some of the we can say good initiatives which are being taken, because we all know that we all can invest, but we don't know how to invest. So there should be some kind of awareness so that all can gain something of out of this market. Okay. Next one is objective of SEBI. So first one is again the same thing, it's written: protecting the interest of all the investors in the securities market and providing a healthy environment to them. Working out for the regulation of the securities market by preventing many malpractices. And last one, promoting the development of securities market with proper and fair functioning by checking over brokers, underwriters, etc. I think you know the term what is broker, right? Broker are those intermediary person who sells or purchase the shares or equities on behalf of their customer. Maybe I want to invest, but I don't know how to invest, and I don't have that much of time to see to sit and study the market. But to study the market is necessary, right? So at that point of time, I can hire a broker who is registered with SEBI. They will be having their trade license over there, which is being registered by through SEBI. So through such a registered broker, I can place my order. I need, suppose, this much of share of this company at this much of price. So he is going to do this on behalf of me. Okay, but in return, I have to pay him brokerage charges. Okay, it can be any percentage that he wants to seek from us. Who are underwriters? Underwriters means it's a kind of institution, I can say. Suppose they are the one who guarantees to purchase some new securities. Now, for example, I am a new company. I have got listed over there, but I'm not sure whether my all the shares will sell out or will be purchased by people or not. So what I can do is I can approach these underwriters, and they can purchase certain percentage of shares. They will promise us that they are going to acquire certain percentage of shares. Fine. Now we can understand the overall objective of SEBI, right? To protect the investors from such kind of unwanted malpractices in the market. Because you all have heard about the Harshad Mehta case, right? For that case, whole economy went down because he did a fraud over there of more than 500 crores or 5,000 crores, like that. So he was knowing everything about the stock market, and at that point of time it was not we can say it was not transparent, because we sitting over here, we cannot see whether the price is going up or down, like that. There was a particular physical market over there. Okay, but now it's all transparent. We can see how the market is working, whether the demand is rising or demand is going down, the price is going up or down, and everything is transparent to us. But at that point of time, it was not transparent, and people don't know exactly what was going on in the market. Okay, so such kind of frauds may happen. So for that, SEBI is there to regulate the market, so that we, the investors who have invested our money should be safe in the market. Fine. So lastly, thank you for this video. In the next video, we will continue about these topics, and we will try to go more deep into the topic over there. So thank you for watching the video. Thank you.